Good morning, everybody. It's Kristen King here from KPMG. Welcome to KPMG Isle of Man's webinar series, where over the next couple of months, we'll hopefully look at a number of topics related to managing your business through a time of crisis, covering the areas that we feel will be beneficial and relevant in the current circumstances. These will include cash flow and liquidity, tax, risks to your business from regulation to fraud, to cyber, and then how this will affect financial reporting. If there are areas you would like covered, then please reach out to us and the team and let us know. We can look into these matters for you in the upcoming webinars. So today, presenting, there's myself, Director in our deal advisory team. We've got Rob Rotherham, Director from our tax team, and hopefully we'll also have Catherine Ridge as well, a Senior Manager from our restructuring team. Russell has been able to join. Hopefully, are you there, Russell?
Yes, I'm here. Hopefully people can hear me. And I will just very quickly run through some of the macroeconomic stuff from the very start. Just looking at the macro position worldwide, it's pretty gloomy, and there's no reliable forecast data out there that says what the global economy will do over 2020 and 2021. But if we look at some of the more developed economies, most European economies are estimating the impact of the closure to be approximately a 3% hit to GDP every month, which would be over 30% on an annualized basis. And looking at the US, Goldman Sachs are currently indicating a potential 30% slump in US GDP in Q2, with a sharp rebound in Q3 should the pandemic containment measures actually be successful. Coupled with this, we've seen US unemployment rise from 200,000 claimants in February to 6.65 million claimants in the current week. And because of the size and reach of the US economy, clearly any stutter in the US will have quite a defined impact on the global economy. On the flip side to this, we are seeing some increased signs of activity in China, with estimates that China is now running at 70% of pre-pandemic close down levels. However, their recovery won't be as quick as they would like, as a lot of their major markets are currently still shut and subject to lockdown measures. To try and cushion this, global governments have tried to come to the rescue with very extensive and indeed expensive stimulus packages, which are currently in the process of being rolled out. Whilst they will cushion some of the impact, they will by no means eliminate it, and they won't be sustainable for long extended periods of time. Turning to the UK position, the UK position as modelled by KPMG is clearly a moving feast. 2 weeks ago, we had an estimated 2020 decrease in GDP of 2.6%. However, remodelling this week has shown a forecast 7.8% fall in UK GDP this year, and hopefully a rebound in 8.4% in 2021. This is really based on being able to start to ease the lockdown during the end of Q2. However, some restrictions are expected to remain through Q3 and Q4, particularly impacting the entertainment, leisure and service industries around large events and other such gatherings. This will also hinder the reduction in unemployment going into 2021, as people will still be somewhat nervous to return to the employment levels we saw before the pandemic. If we look to the Isle of Man, we don't have a great deal of statistical information available on our local economy, but just some factors to think about when we look at how the economy is made up. Financial services has not been as impacted as some of the leisure and hospitality sectors, and we are an economy that is approximately 70% financial services and e-business based, with the key sectors being insurance, private and corporate admin through the CSP sector, and e-gaming. All of these businesses are suffering to a degree. However, they are largely operating and not subject to the shutdown that we're seeing across the rest of the economy. Indeed, a Chamber of Commerce survey yesterday was released stating that 90% of respondents had seen a downturn in the last couple of weeks, and 30% were looking to furlough staff fairly imminently. That's based on largely small and owner-managed businesses. So that's to be expected in the sort of sectors that they're probably focusing on, being retail, hospitality, and leisure. Turning to the retail, hospitality, and leisure sector, they are being particularly badly hit, especially coming off the traditionally more difficult winter months. And it's important that they're able to manage their businesses and seek support as they require over these coming months to ensure they're able to reignite after the lockdown restrictions are hopefully lifted in the not too distant future. Looking specifically at the Isle of Man support measures, and the government has moved quickly and have moved to try and provide an element of support to the very, very much needed hospitality, leisure and retail sectors. The support includes matters such as wage support, VAT deferrals, grants for the self-employed, and the loan guarantee scheme backed by local banks. On the non-governmental side, business community is coming together behind the Manx Solidarity Fund to try and raise funds and then direct those funds to cases of need as they see fit. All of the details of the support packages are available at the Isle of Man Government COVID website, which you can see hopefully on the screen.
So good morning, everybody. It wouldn't be a webinar if there wasn't technical issues. So thank you for bearing with us. So currently, many businesses are closed or in the process of being mothballed. Others are suffering disruptions, including reduced hours of operation due to government restrictions, whilst others are confronted with supplier or customer delays. Regardless of sector, the inability to generate adequate cash flow jeopardizes the ability to meet obligations to employees, lenders, creditors, and investors. So during COVID-19, there are two key principles to help you get through your business through this uncertain time by: one, managing your cash flow, and two, engagement with your stakeholders. I'm going to focus on cash flow, and I'm hoping that Kristen can join us again to talk about the stakeholders. There are a few key measures you can take as a business to manage your cash flow during the coming weeks and months. It's a well-used saying, cash is king, and this is particularly true in a period of such economic uncertainty. In short, it's all about getting cash in the door. Under normal trading circumstances, we'd expect businesses to have a rolling 12-month cash flow forecast, which would help manage cash peaks and troughs throughout their annual cycle. However, in times of crisis such as this, the focus needs to be radically shortened to a rolling week-by-week or even day-by-day focus on liquidity. Understanding your cash burn rate and when you're likely to run out of cash is imperative. And this is particularly important given that we currently have no clear idea as to when the likely duration of this economic current conditions. Let me clarify what I mean by cash burn rate, as it's such a key indicator. You're effectively looking at how quickly you're spending cash, typically measured for a month. For example, in a month you generate cash revenue of £10,000. Your spending is £15,000, so your monthly cash burn rate is £5,000. Obvious, but it will help you think about how long any existing cash reserves will last. The key question is, with so many unknown variables, are you comfortable that you have access to adequate liquidity to support your known short-term outgoings and also manage through any potential unknown challenges? So I'll briefly run through a few cash and liquidity management tips that we've built up over the years through working with our global KPMG colleagues, assisting our clients, talking with banks, and also from running our own business at KPMG. Typically, in times of distress or crisis, we'd recommend to clients that, in addition to 12-month forecasting, to prepare cash flow forecasts for a rolling 13-week period. Why 13 weeks? Well, it's one fiscal quarter, which is long enough to have oversight on the impact of strategic decision-making, while remaining short-term enough to be able to provide a high degree of accuracy. However, the difficulty with this crisis is that impacting at both a micro and macroeconomic level, and timeframes are completely unknown. We've spoken to a number of local banks and are suggesting that disruptive factors should be factored in at least 6 months at a minimum. So in times such as this, where there is exceptional and widespread uncertainty, we're recommending that forecasts are extended to a 17-week period to cover an additional month on top of the quarter to ensure additional resilience. Key considerations while forecasting. Well, together with these assumptions, these will be unique to your business. However, I'll outline a few key things to consider. Many of these may seem obvious, but we can often see forecasts that are incredibly optimistic or conversely overly pessimistic. So do run your assumptions past other people in your business to get their input and challenge. Undoubtedly, assumptions which will have been relevant prior to the crisis will be outdated and no longer reflect the reality that we're currently facing in the world. So first of all, revenue when assessing your projected cash receipts. Start with known debtor positions. Review of aged debtors and active follow-up with outstanding debtors, as proactive cash collection is essential. However, do be realistic about what's possible. You may wish to think about coming to repayment arrangements with your debtors in order to get a steady stream of cash rather than wait for settlement in full. After all, they will be facing the same challenges as you. When looking at current and future sales income, it may not be appropriate to use your usual profile of sales or fees. Such thing as time-based fees in particular, you may need to revise these based on realistic staff utilization due to disruption and the impacts of remote working. You may wish to renegotiate customer contracts for payment on delivery. Any businesses with physical goods or stock should be considering other means to sell goods if shops are closed, and also factor in any impact of obsolescence or devaluation. Are you eligible for grant assistance under the Enterprises Coronavirus Support Scheme, which Russell was going to mention, but I'm sure we'll cover that at some point. So expenses. Start with fixed costs, i.e. the ones you know that are unlikely to change. So mortgage, rent, salaries, insurance. Are any of these able to be deferred in the short to medium term? Some banks we've spoken to have indicated that they're willing to discuss mortgage holidays or deferrals. So it's worth analysing which costs, if any, may be deferred. In terms of wages and salaries, will you be eligible for the wages support scheme? Remember to factor in any likely changes to variable costs based on your current and forecasting model and focus how these can be minimised. For example, utility cleaning if your office is shut. You may wish to take advantage of the VAT deferment initiative to defer any payment due to the Treasury between now and the end of June. Also consider deferring dividends and distributions, which may put undue strain on cash reserves. Assumptions and stress testing. So remember to take a written note of assumptions that you're making to keep an audit trail, as these assumptions will change over time as more information becomes available. Do try to stress test your cash flow forecast. This means simply modelling it over a range of what-if scenarios. So best, base, worst. As this can assess the potential financial impact across your business. For example, what happens if income drops 5%, 15%, 20%? Can I still cover my fixed costs? How much headroom will I have under each of these scenarios? This will help highlight any likely minimum and maximum funding requirements, and also the timing when seeking bank credit or additional equity funding may be critical. Forecasts should be updated weekly or even daily as new information comes to hand, and assumptions need to be tweaked accordingly. By demonstrating that you're in control of your cash position, you'll be able to approach stakeholders with confidence. And finally, it's imperative that you document board assessments and decision-making, particularly in relation to assessments of solvency, balance sheet and cash flow solvency, as this could be scrutinised in the future. You may be aware of the UK government decision to temporarily suspend wrongful trading provisions retrospectively from 1st of March 2020 for 3 months for company directors, so they can keep their businesses going without the threat of personal liability. Whilst there's no specific wrongful trading provision in the Isle of Man, there are other statutory provisions which means that directors could be personally liable for the liabilities of the company, such as fraudulent trading, where directors carry on and incur debts with the knowledge that there are no reasonable prospect of these debts being repaid, or unlawful distributions. So this may mean while a company is solvent, a director in exercising his duty to the company is required to have regard to the interests of the company's present and future members. However, once a company is insolvent or insolvency is a real possibility, there's a change of interest. In exercising their functions, the directors are required to have regard to the interest of creditors who will be repaid from the company's assets. Any breach of fiduciary duty, a director may be liable to indemnify the company for loss suffered. Therefore, extremely important to document any decisions and seek appropriate professional advice if in doubt. Insolvency and director considerations will form part of a future webinar that will cover, again, liquidity and other considerations in a crisis. So moving on, another tip which we find helpful when prioritising cash flow decisions is rating outflows into green, amber and red categories so that you can identify areas that may avoid or defer the requirement for lending or extending current credit facilities. Green are the cash flow management actions that you can accelerate or push harder on. For example, push harder on debtors or customers paying late. And on the expenditure side, seeking some breathing space through agreeing a deferral of utilities. Amber are tactical actions you'd prefer not to do but need to consider. For example, deferring mortgages or discretionary expenditure such as marketing or capital spend, or deferring M&A activity. Red, emergency actions, deferring payroll or rents. These need to be considered very carefully. In summary, it's important not to bury your head in the sand and take action. The earlier you consider both your best and worst case cash flow scenarios, the more proactive you can be to ensure the survival of your business. We'll be doing a more detailed session on cash flow, looking at financial modeling, stress testing, contingency planning, managing business in distress in future I think it might be next week. What I'd like you to do is, if there's any particular scenarios that you'd like to cover, you could comment at the side or get in touch directly. So I was planning on handing over to Kristen, but
so in relation to stakeholder management, your initial concerns are understandably going to relate to business continuity in the short and medium term, and by now it's likely that you will have spoken with most of those stakeholders to give them your initial view on expectations for the business. And you will have told some of them of the immediate actions that you've taken, for example, to move all staff to working from home. Some businesses will have experienced an immediate downturn in revenue and may have been forced to close due to the regulations that are in place or to cessation in demand. Others of you will be able to continue to trade, but may have to operate differently and may not yet be able to gauge exactly what financial impact COVID-19 is going to have on revenues. But whatever the scenario, you need to liaise with your key stakeholders, either to ensure your business continues to operate in its current state or can be preserved in a mothballed form, or in a worst case, is closed down appropriately to minimize future consequences. As mentioned, we'd expect all businesses to have taken their initial actions to react to the current situation. But as each day passes, you'll be gathering more insight into how your business is performing following those actions. But it's still too early to be confident that the performance over the last 2 to 3 weeks is representative of how your business will continue. And perhaps for some of you, you'll be hoping that isn't how your business will continue if the impact has been severe. But you should now be considering the potential scenarios that might play out over the coming months, how you would react to each of them, and what this means for your communication with your stakeholders now. In relation to your shareholders, COVID-19 might represent a challenge for some businesses and an opportunity for others. You may need funding to help retain staff or maintain assets through a shutdown, or for capital expenditure to support new working practices, or for the lucky ones, perhaps an opportunistic acquisition. But any of these scenarios might require additional funding, and your shareholders are likely to be the primary source for this. It's important that you understand the extent of resources available to your shareholders, and indeed the liquidity of their own funds. Shareholders will have their own cash requirements and will have varying levels of capital that might be available to them to inject into the business. If you believe that you're going to need additional shareholder funding over the coming months, then it's important that this is identified early. If you intend to approach a bank or financial institution for lending, then they will expect your shareholders to have skin in the game and to have injected their own capital first where possible. Most lenders have had to initially focus on assessing the status of their existing loan book and, where necessary, reassess the terms of existing debt. But this really is where necessary, though. The lenders do not intend for assistance measures to be taken up by businesses that don't actually need it. In the first instance, lenders are most likely to agree to capital repayment holidays on existing lending, but may still require interest to be paid in order for the loan to still be considered performing and to avoid regulatory capital consequences in the cases of the banks. The high street banks do understand the need to support business through additional debt finance. However, lending still has to make commercial sense, so do bear this in mind. And when assessing applications for changes to existing terms or for new loans, lenders will want to see financial forecasts and scenario analysis that reflects the position whereby COVID-19, the impact lasts for at least 6 months. Assumptions for the speed of return to normal levels of business should be phased in over time, and it's too easy to be overly optimistic. So do be fairly harsh on yourself in modeling some of those downside scenarios. As mentioned, they'll also expect shareholders or the business itself to take some of the pain in the downside scenario. For example, if there are significant cash resources available, a lender would expect some of these to be used first in order to fund the business initially. You should also consider what assets the business has available that could be given as security, although do bear in mind again that limited weight might be attached to personal guarantees or security in many cases. If you know that you're going to miss a covenant test or a repayment, then it's particularly important that you contact your lender in advance, reforecast your business, and go to the lender armed with sufficient detail to be able to tell them the terms that you think you can comply with. That will be a good starting point for negotiations, and the lender will place some value on your ability to be able to do this in the first place. From speaking with them, the high street banks have received a lot of queries and applications for changes to existing terms and for new debt. Tell me that the application processes are being increasingly automated in order to speed this process up for their customers. The bank staff are working from home and normal service is being maintained, so there should not be any significant implications in terms of the bank's abilities to operate and make decisions. In addition to normal lending, you may have seen that the Isle of Man government has agreed to underwrite 80% of £60 million of new lending for Isle of Man registered businesses with turnover of less than £10 million that would otherwise not qualify for bank lending. These loans have a maximum term of 6 years, and the scheme is being implemented by Barclays, Conister, HSBC, Isle of Man and Lloyds banks, and it is them that you'll need to contact to understand the specific lending criteria that they intend to apply. Something else that may help is that Treasury has announced a number of tax measures, as Rob has already mentioned. However, tax isn't the only regulatory framework for many of you, and you'll be operating within sectors such as financial services and gaming, and will have ongoing operational compliance requirements as well as filing deadlines. Yesterday, the FSA announced an extension to the deadline for filing audited accounts for those companies normally required to do so within 4 months of their year end. The deadline has been extended to 6 months and will apply to many businesses that were due to report by 30th of April. So that may buy you a little bit of additional time for those that have experienced delays due to perhaps the switch to working from home or staff absences. Your financial resources returns must still be completed as usual, but for the moment, last year's audited expenditure figure can be used until your current audit is completed. However, if you expect your new audited figures would have resulted in a breach, then you must notify the FSA and provide them with an explanation. It's also possible that as a result from working from home for your staff, your normal operating processes are having to be amended. And whilst most firms operate with electronic files these days, it's not the case in all instances. And so the timing of some day-to-day compliance activities may be impacted. Again, the key is to be clearly aware of your regulatory deadlines and key compliance controls, and to identify any potential issues early and contact the regulator to discuss your issues and potential solutions. In relation to customers, obviously to have a successful business, you need to retain your customers. Even if you can't serve them at the moment, you want them to purchase from you as soon as you're operational again. Other businesses may continue to operate, but will have changed the method for delivery of their services, and some businesses will be overwhelmed by excess demand and have to deal with the challenges that this brings. But in all cases, regular, clear communication is going to be key. If you close your business temporarily, remember to keep up some of the marketing to keep your clients warm. Ask them how quickly they're likely to return when restrictions are lifted, and to what extent there will be extra demand initially to compensate for the shortfall whilst you are closed. You need to plan to avoid service issues when business resumes that might mean you lose customers for good. If your business has essentially continued as normal, but staff are working from home, or you've changed your method of service delivery, I think many of us will be familiar with fish and chip shops now delivering, this can change how or when you want your clients to interact with your staff. So make sure you tell them how this is best achieved to avoid frustration or to avoid missed sales where clients might actually have expected you to be closed. If your business is in a sector that's experiencing increased demand, then you might need your clients to understand that you can't deliver quite as quickly as you normally would. Most clients are willing to wait if they know when to expect the service, so keep communication open and clear. Whichever scenario your business is in, you'll also need to liaise with your suppliers and employees. Your employees will be concerned for differing reasons. For some, the concerns will be financial, either because they fear redundancies or furloughing, or because they have children to look after and won't be able to work. In other businesses, staff will be concerned about the number of additional hours they need to work or the safety considerations whilst doing so. Your business forecasting should have informed your overall expectations in terms of how you expect the current situation to change your workforce requirements. Choosing when to communicate those expectations can be difficult. It may depend upon your knowledge of your teams and how you expect them to react personally. For smaller businesses, you may be able to speak with your employees individually, whilst for others this may not be practical, but it's important that they receive communication from the top of the organisation as well as from their line managers. If you need to reduce your wage bill, then asking staff to voluntarily reduce their hours or to take unpaid leave or go into the wage support scheme may be sufficient, as where they can afford to, people will often offer to share the pain rather than see individuals made redundant. That was certainly experience that I witnessed with KPMG UK after the financial crisis, although I realised clearly that unpaid leave is slightly less attractive at the moment in a lockdown scenario. In addition to your employees, though, your business will have a range of suppliers and the initial priority is to be in contact with those upon whom you depend for business continuity. You may need to adapt your business in order to receive supply by the means that the product or service can now be provided. The suppliers may have changed their operating models just in the ways that you have. For many of the island's businesses that are in professional services sectors, this is not such a difficulty, as key inputs are employees, and services are often provided electronically. However, for manufacturers and retailers, it is possible that whilst you believe you can still serve your customers, there may be a supplier that cannot provide one of your key inputs, which in turn prevents you from operating. You may even need to provide support to a key supplier, and that should be considered. As restrictions may change from day to day, it's also necessary to continue to be in regular contact with key suppliers to ensure that continuity of supply is there. Unfortunately, if you have rerun your own forecasts and realise that cash and cost control is going to be critical to your business surviving, then you also need to quickly determine which services you can live without and terminate them. Finally, almost all businesses have changed how they operate or the services that they deliver. These changes are likely to lead to changes in risk, and you should remember that you may need to notify your insurers of this in case you need to make a future claim, so this will need consideration. These are all the key stakeholder categories that we're believing to manage in the short and medium term in order to preserve or grow your business in the current circumstances. Regular communication is the common factor, and whilst always important, is even more so now, and this should be ahead of time wherever possible in order to avoid issues that could have a detrimental or even terminal impact on your business.
So I'm just going to start with a quick summary of the tax measures introduced by the Isle of Man government over the last couple of weeks, and then just go on to consider some wider issues which might be relevant to local businesses. So there are two main local measures. Firstly, as already been mentioned in passing, I think there's a VAT deferment initiative that's been announced. It works by allowing any VAT payments which are normally due to be made between 23rd of March and 30th of June this year to be deferred until a later date, but that later date can't be any later than 31st of March next year. And no late payment interest or default surcharges will be payable under this initiative. And to access the initiative, businesses have been asked to contact Customs and Excise directly. I should say that businesses are still required to continue submitting their VAT returns as normal throughout this period, and Customs have confirmed that refunds and reclaims will continue to be processed and paid as usual. So whilst this initiative is open to all VAT registered businesses in the Isle of Man, the Treasury have been keen to emphasise that those businesses who haven't been significantly affected should just try their best to pay their liabilities as normal, because of course the government now more than ever could frankly do with the cash. Just finally on this point, remember it isn't a waiver but a deferral, so anything that's not paid now is of course going to need factoring into longer term cash flow forecasting, that kind of thing. The other main tax related initiatives are employees' national insurance holiday. Whilst the VAT deferment initiative is open to all businesses, this measure is very much aimed at particular industry sectors and those sectors that the government consider are going to be worst hit. There has been a government circular been issued which sets out those relevant sectors in full, but at a high level it's those businesses whose income comes wholly or mainly from tourist accommodation, catering and entertainment, leisure, travel, tour operation, and those logistics companies involved with the movement of goods into and away from the island. And this is a 1 month holiday from the obligation to pay employees Class 1 NICs for the month of March, which would ordinarily have been payable by 19th of April. And from a technical perspective, works by reducing the rate of employees Class 1 NICs to 0% for that month. We do expect that measure is going to be extended for a further 2 months into April and May, but that's yet to be confirmed by Treasury. So changing subjects slightly, whilst on a financial measure, something else worthy of mention is that the Treasury last week confirmed that they'll make allowances for the late filing of local tax returns over the coming weeks and months. The full details are contained within a practice note which can be found on the Income Tax Division's website. But in terms of the key points, for personal tax returns, anyone who hasn't yet filed their 18-19 tax return, which is well overdue now, would ordinarily be looking at a £200 fine if they fail to submit that by the 6th of April, so the Monday of this week. That penalty would be waived as long as the return is submitted by 5th of June. Returns for the 1920 tax year are going to be issued as normal in electronic format to existing users of the online filing system sometime very soon, we think. The new tax year has, of course, just started. Those who aren't registered for online filing will receive their paper return late, possibly as late as the end of this month. And the division are going to consider whether all of this is going to result in the filing deadline, which is typically 6th of October, whether that needs to be extended for the submission of both types of return, for both electronic and paper versions. Employees' tax returns for tax year just ended, so those containing end-of-year tax year summaries for employees' ITIP and national insurance deductions, those would normally be due for filing on before 5th of May, but they can also now be submitted up until no later than 5th of June. And then equally, any company tax returns that are due for filing between 1st of April and 5th of June, so that might be companies with 31 March 19 year ends, for example, they have until 5th of June to file, and they won't be charged a penalty if they meet this extended deadline. And that also applies to any second late filing penalties which fall due within this period. So essentially, any tax returns that were due in the period 1st of April to 5th of June now have a deadline of 5th of June. The Income Tax Division have noted that, like many of us, they're working at a reduced capacity and in a remote fashion, so we might see delays in the processing of returns, etc. They have asked that people only contact them to chase up processing of returns if the taxpayer is expecting a refund of tax and they're also suffering financial hardship as a result of the current crisis. And then finally, just as a general point, there are currently no other official measures, but if any individual or business is struggling to meet any of their tax liabilities as a result of the pandemic, I would just encourage them to open a dialogue with the tax authorities at the earliest opportunity, because I know that they're trying to take a pragmatic view where possible. So those are the local measures that's been announced. I thought I'd just also outline a couple of other issues which are worthy of some consideration in these unusual times. Clearly, there are many people who currently find themselves in places where they wouldn't expect to be, at least not for an extended period of time, and are effectively stranded there until further notice, and perhaps that's because of travel restrictions, or maybe they've taken a personal decision to be near to people who need their support. So tax is probably the last thing on people's minds in those sort of situations, but unfortunately there are a few tax issues that this could possibly result in. So firstly, if a person finds themselves staying in a jurisdiction that isn't their usual jurisdiction of residence, and they're there for an extended period of time, then there might well be a risk that they inadvertently become tax resident there. A lot of countries make allowances for exceptional circumstances, and you'd hope that the current situation very much fits that definition. For example, HMRC in the UK have issued some guidance quite recently on this point. But there are some jurisdictions that have no equivalent exceptions, albeit we would hope that there'd be further one-off exceptions in relation to the pandemic introduced over the next sort of few weeks and months. So I guess if anyone is in this situation, all I would say is that they need to start by checking the rules which apply in that particular jurisdiction and going from there. Now, even if an individual can satisfy themselves that they aren't going to become tax resident in a particular jurisdiction, that might not be the end of the story from a tax perspective. So, for example, if they're an employee of an Isle of Man company, it's possible that if they continue to perform their employment duties somewhere other than the Isle of Man, again for an extended period, then their Isle of Man employer might need to register for and even pay local payroll taxes and possibly even social security contributions. Now, again, it might well be that even if this is the strict technical position, the local tax authorities are able to take something of a pragmatic view in the circumstances, but it's not something that we can rely on. It just needs to be looked at in all cases. And then another possible side effect of people performing employment activities in foreign countries is the risk of creating a permanent establishment, a taxable presence, so of their employing company. And that's particularly where the person concern is performing value-added or fee-generative activities. So where, say, an Isle of Man company has a person performing employment activities from a fixed place, and that might even be just their home in an overseas jurisdiction, then that might be sufficient to represent a permanent establishment, depending on the local tax rules. In which case, the Isle of Man company might end up with a local corporate tax liability. So again, if you have people stuck overseas in this sort of a situation, I would just encourage you to look closely at the local rules and see if there are any COVID-19 related carve-outs. And it isn't just personal tax residents that might be affected. There's also scope for company residents to be impacted. There are certain jurisdictions, UK included, where dialing into board meetings, which are physically held somewhere else, runs the risk of the company in question being deemed to be centrally managed and controlled, even if only partially, from that jurisdiction, and therefore potentially deemed tax resident there. Now, this might have the effect of that company being subject to tax in that jurisdiction, potentially its worldwide income and gain. So it's clearly that something that you try to avoid where possible. Lockdowns and travel restrictions might well make such situations unavoidable, but in those sorts of cases, I think it's important just to check the implications before taking action, before dialing into a board meeting, or at the very least, so clearly documenting why such a course of action was necessary and unavoidable. And as a bit of a stop press, I should mention that just yesterday, HMRC issued some guidance on their approach to permanent establishment and company residence matters in the context of COVID-19, and that's obviously worth a look if that's where your concern lies. Just yesterday too, the OECD released some high-level commentary on these issues. And then finally, for me, on a related topic, those familiar with the economic substance rules will no doubt be aware that one of the requirements for in-scope Isle of Man entities is to be directed and managed in the Isle of Man. Directed and managed is a similar concept to tax residents and crucially requires sufficient board meetings to be held in the Isle of Man with a quorum of physically present directors. So for companies with non-Isle of Man resident directors, the island's closed borders might well make that impossible, at least in the short term. The Income Tax Division haven't issued any guidance or reassurance around this point as of yet. The authorities in some of the jurisdictions actually have. But I'd be surprised if they didn't take a similarly pragmatic approach, as long as it was clear that what was happening currently in terms of people not being able to make it to the island was just an unavoidable interruption to an otherwise compliant way of doing things. That was where I was going to stop and hand back over to Russell.
Yes, Andrew. I'd just like to finish now by thanking everybody for their forbearance today as we have struggled with our technology, but also to thank my co-presenters, and also to let you know that a copy of these slides will be available later on this week. And once again, thank you to you all for joining today.